I'm going to talk this morning about a topic called Stakeholder versus Shareholder Capitalism. So this lecture came about because in March of this year, I was invited to testify in front of the Joint Economic Committee of the U.S. Congress, which is a committee that consists of both senators and members of the House of Representatives, and it's geared towards economic topics. And the topic I was invited to speak about had the title, "What happens when you put share prices first?" And the hearing was about something very fundamental, which is what should be the goal of a company? What should be the goal of a company? And there is a historical view that many attribute to Milton Friedman, but goes back long before him, although he was one of the key people to articulate it, that companies should primarily be thinking about maximizing shareholder value. Okay, getting the greatest return on investment for their shareholders. There is a newer view called the Stakeholder View, which says that companies should have a much broader set of purposes. And so as with the other lectures, I'm going to start us off with a poll here. And the poll is just to get your thoughts about what you think about this issue coming into it. So this is not a right or wrong. This is what the way you think the world should be. The polls are again going to be at pollev.com/Rauh, pollev.com/Rauh, R-A-U-H. Okay, so you'll need a device, cell phone, laptop, tablet, whatever you got. Okay, pollev.com/Rauh. And I'm going to activate it, and I'm going to just read through. There's a lot of text here, so I'm just going to read through these first. And this is not one that I want you to answer necessarily as quickly as the other ones from yesterday. You can think about it for a minute or two. Okay. The question is, what should be the responsibility of the CEO of a corporation? What should be the responsibility of the CEO of a corporation? And I've put up a few choices here. Okay, I'm constraining you to these choices, so if these aren't exactly, maybe you're not finding here exactly what you want. Okay, sorry about that. You'll have to pick one of these, whichever one of these is closest to your view. So what should be the responsibility of the CEO of a corporation? The first option is to maximize profits without breaking the law. Maximize profits without breaking the law. That's maybe the narrowest one. Next, to maximize profit without breaking the law or behaving unethically. Next, to serve the objectives of the corporation's shareholders, whatever they may be, without breaking the law or behaving unethically. So the difference between that one and the previous one is that the objectives of the corporation's shareholders, these are the people who own the shares in the corporation, perhaps it's to maximize profit, but perhaps those shareholders want the firm to do something else. Whatever their objectives might be, is it the CEO's responsibility to carry them out. Fourth is the responsibility of the CEO of a corporation to serve the interests of all stakeholders, including customers, employees, suppliers, and also shareholders. So is the responsibility to look after the broader interests of all of these people who have something to do with the firm. And then the last one is the most broad one, is the responsibility of the CEO of a corporation to serve the interests of all stakeholders, including customers, employees, suppliers, and shareholders, so all the people in the fourth option, as well as broader societal goals, including racial justice and protecting the environment. Okay, yes?
Can you elaborate on what stakeholder?
A stakeholder, so a stakeholder is every person, every entity that has some, for whom the actions of the corporation have some impact. So stakeholders include the people listed up here. Okay, customers of the firm, employees of the firm, suppliers, as well as shareholders. Shareholders are one of many stakeholders. Okay, so think about it for a minute. Okay, 20 people have voted. If you're still thinking about voting, is anybody struggling or thinking that there's a question they want to ask about clarifying something here? Get the basic idea? And this is I know how you're feeling, because this is the situation I was in. I was asked to go in front of the United States Congress and tell them what I thought the purpose of a corporation should be and the responsibility of a CEO. So I thought about it for a long time. And hopefully after this lecture, you will also continue to think about it for a long time, because it's a really big and important question. And there are a lot of policy questions that fall right off of this, which we're going to go into. So 24, okay, that seems about right. So I'm gonna close it down now. And very interested in what your responses are. Okay, so nobody said maximize profit without breaking the law. I am just going to assume that's because you concluded correctly that the next one allows also for some consideration of ethics, and we don't really want CEOs just to be going around behaving unethically. So, so few of you said maximize profit without breaking the law or behaving unethically. The modal response was definitely to serve the objectives of the corporation's shareholders, whatever they may be, without breaking the law or behaving unethically, meaning that the job of the CEO, the boss of the firm, the head manager of the firm, is to attend to the desires of the shareholders. Okay? 25% of you said that the CEO should serve the interests of all stakeholders, including customers, employees, suppliers, and shareholders. So shareholders are just one of a group of stakeholders. And 17% of you voted for that, plus the idea that the firm should also serve broader societal goals, including racial justice and protecting the environment. So when I was called to come to this hearing, you can say whatever you want when you're called to testify. Nobody tells you, we expect you to take this side or the other, although usually they call you with some idea in mind of what it is that you might say. And you can decide to disappoint them if you like. The position that I ended up taking was very, very close to this one here, to the modal response. Although when I dug into this a little bit and did some research and thought about it a little bit more, I realized that there were even some questions about this that need to be answered when we think about the objectives of the corporation's shareholders, particularly when the corporation's shareholders are a really heterogeneous group of people who believe a lot of different things. So if you followed politics in America at all, or public opinion in America at all, you might have heard that things are incredibly polarized there. Okay, so you have some people who are very much on the left in favor of social justice as being sort of the primary grounding principle for them. You have a sort of large center, and you also have people on the right who are very much populists or right-wing populists. And if you think about it, those people, and I'm going to show you some data on this, all of those people own shares in companies. And part of that is because in the US, as is also the case in Israel, we have very, very broad shareholder ownership. A lot of households in America actually own shares. So what do you do if you're the CEO of a corporation and you have both leftist social justice warriors and right-wing, what Joe Biden would call MAGA Republicans, who own shares in your company? What are you going to do? Those people don't agree with each other on hardly anything. So how are you going to manage the company in their interest? What are you going to decide? Because you've got this huge range of people who have very, very different views about a lot of these stakeholder types of topics here that I've mentioned. So great. So that's the introduction to the topic. And let's go through a little bit about sort of some of the intellectual history of this. And usually the place that we start at the Friedberg Institute is often with Milton Friedman. Friedberg, different name, but maybe similar intellectual geist. Okay, so the shareholder model of capitalism is most commonly associated today, especially with Milton Friedman. And in 1970, I mean, this is 50 years ago. Okay, for more than 50 years ago, Milton Friedman wrote an op-ed in the New York Times where he said this quote: "The corporate executive's responsibility is to conduct the business in accordance with the owner's desires, which generally will be to make as much money as possible while conforming to the basic rules of the society, both those embedded in law and those embedded in ethical custom." That is what he wrote. Now, the title of the article is a little bit different. The title of the article is "The Social Responsibility of Business is to Increase Its Profits." So I don't know, I've been looking around for the history of how that title got on the article. I suspect that a journalist put that title on the article, because I have written op-eds for newspapers before, and what often happens is you send them the article and they slap some title on it that's not the title you gave it, because they actually want to attract a lot of readers and they want something that's really going to be controversial and shake things up. So in the article, Milton Friedman does not exactly say the social responsibility of business is to increase its profits. That title, which of these options is that title most consistent with? The first one, to maximize profit without breaking the law, right? He says the social responsibility of business is to increase its profits. If that was the title on the articles. The title of the article is actually most consistent with the one that none of you voted for. But if you read the article, that's not actually what he said. What he said was the responsibility of the CEO is to conduct the business in accordance with the owner's desires. The owners are the shareholders. I'm going to talk to you about that in a minute, the structure of the corporation. The owners are the shareholders. To construct the business in accordance with the owner's desires, and he said, which generally, very important word there, will be to make as much money as possible, while conforming to the basic rules of society, both those embedded in law and those embedded in ethical custom. So he's clearly also allowing for room for behaving ethically, okay? So he's not saying you should behave unethically. So he's at least in this second category, but maybe even the third. The third was serve the objectives of the shareholders, whatever they may be. And he does say run the business in accordance with the owner's desires, which generally will be to make as much money as possible. He doesn't rule out that they might have other objectives. And in fact, the article goes on to say, of course, in some cases, the employers may have a different objective, for example, a hospital or a school. The manager of such a corporation will not have money, profit as his objective, but rendering of certain services. In either case, the key point is that in his capacity, I mean, this is one way in which 50 years ago we could have had a little more inclusive language, his or her capacity as a corporate executive, the manager is the agent of the individuals who own the corporation, and the primary responsibility is to them. Okay, so his main point is the shareholders own the corporation. If you go and you buy a share of Amazon stock today on your phone, on Robinhood, on a trading platform, you are very small, but a part owner of that corporation. You own shares in that corporation. That's what it means to own stock. And what Friedman says in his article is that the key point is that the manager of the company, the boss of the manager of the company is you. If you own shares, you're the boss of the manager of the company. Now, really, the boss are going to be people who own a lot more shares than you or I, because there's some people who own a lot of shares, and so they have a pretty heavy weight in the discussion of what the CEO should do. Okay, any questions so far? Yeah.
Not to be too nitpicking, but
yes.
When he says that his primary responsibility is to the owners, doesn't
yes.
this leave room for other interested parties?
Could leave room for other interested parties, right? And that's another point in a way that illustrates the fact that the title was really like taking a hammer and a sledgehammer onto this very carefully worded article. So it does perhaps leave open the idea that there could be other interests in mind. So yeah, and now I think reading the whole article, it's not a very long article, it's an 800-word opinion piece. And one of the most cited opinion pieces of all time. If you can write an opinion piece like this, do it. Because, 50 years later, we're still reading his opinion piece. 50 years later. I mean, I feel happy if, 2 hours after my opinion piece gets posted, somebody's still reading it, right? So, I mean, this is 50 years. So if you can write something where people are still poring over this after that many years, you've done something really good. Okay, so let's talk a little bit more about this. I think it's important to understand what is the structure of a corporation, of a company, all right? A company. So, if you decide that you're going to start a business out of your garage or out of your backyard or out of your apartment, initially you're going to start off, you're not going to be a corporation, you're going to be just what's called a sole proprietor. You're just going to start running your business. You're not going to formally incorporate the business. You're just going to, you've decided you're going to start developing apps. You decide you're going to start selling something. You're just doing it out of your, out of your own space. You haven't really fully, formally formed the company. After a while, though, particularly if you're going to want to get outside capital from a venture capitalist, or if you want to list your company on a stock exchange, you're going to have to incorporate the company, which means to sign formal legal documents that make it so that the company is itself a legal entity, a corporation. And when you do that, and any business that's going to grow beyond a few employees is going to do this. No matter what country, you're going to have this. The structure of your corporation is going to look like this. Okay, the shareholders own the company. You as the founder of your business out of your apartment, you as the founder are going to be a majority shareholder of that company. But maybe you go out and you get some venture capital. Those venture capitalists then become shareholders with you. Maybe they say, I will give you, venture capitalists will say, I'll give you, $100,000 in exchange for shares that are worth, 25% of your company. So then you, the founder, own 75%, and the venture capitalists own 25%. So shareholders include you as the founder, but also anyone who then invests in your company. And those are the owners of the company. Venture capitalists don't typically take a majority share in the company. They still want you to be able to manage this company that you've started out of your apartment because they're investing in you and your idea. But sometimes investors will say, I'm only going to invest in this company if you give me a majority share. If you give me more than 50% ownership in the company, and then that person becomes the majority owner, then they kind of can call the shots a little bit more than you. You know, if you're a minority shareholder, if you're a non-majority shareholder in a company, then in a sense, you're kind of working for the majority in some way because that majority can have a pretty big influence on what you do. So, okay, so shareholders own the corporation. They are the owners of the business. If you incorporate your company, have a bigger company, all bigger companies have something called a board of directors. So board of directors, and we typically look at this and we think, okay, this is a bunch of important individuals or people who think they're important. I don't know. What is this board of directors? What are they doing? The board of directors is elected by the shareholders of the company. So again, imagine you've started this business out of your apartment. You've gotten some outside investors. So you own the company, but also some of your outside investors own part of the company. And then together you decide, okay, who's going to be on the board? Who's going to be on the board of this company? The board of the company is going to be responsible for advising, managing, overseeing important decisions of the company. So you're going to go out and you're going to try to get knowledgeable people onto the board of the company, people who can help make good decisions for the company. So shareholders then are going to elect that board of directors. What's the board of directors do? They appoint and oversee the managers. Managers include the CEO of the company, right? You might initially, as the founder, be the CEO, but if you're a serial entrepreneur, you're going to want to start another company. Or maybe you don't have enough time. You're going to need a professional manager to run the company and do everything that the company needs to have done for it. So you're going to need to elect a manager. And how are you going to do that? The board of directors is going to appoint and oversee the company, right? So the managers are the CEO. They're going to manage the company. And then we have all of these other stakeholders in here, right? You asked before, what are the stakeholders? Well, we have suppliers selling to the company. We've got up here in the upper right, suppliers selling to the company. You've got customers buying from the company. The company employs employees. There's a legal system that regulates the company, right? So that's the structure of the corporation. And you can't get away from the fact that the owners, the ultimate owners of the company, are shareholders. I mean, people in the hearing I was in actually tried to do an act of sophistry and argue, well, shareholders don't really own the company. They don't really own the company. To which I was prepared with an example that I didn't actually have to use in the hearing because it didn't get that heated. But one of the members of Congress had started, before they became elected a member of Congress, they had started a well-known wine shop, a chain of wine stores that sell wine called Total Wines, very, very well known in the United States of America. And I said to that, I was prepared to say, if necessary, if they said, well, the shareholders don't really own the corporation, I was going to say to them, well, look, I don't know who's running your store while you're here in Congress. Congress is a full-time job. You've got to kind of put aside your business interests. I was going to say to them, I don't know who's running your store, but would you like me to tell them that you don't actually really own this business that you started? Okay, the fact is, you can't redefine words. The shareholders are the people who put the capital into the company. They own the company. You can't really get around that. So fortunately, we basically got agreement on that in the hearing, although a couple people tried to say, no, the shareholders don't really own the corporation. Society owns the corporation. There are people who make that argument, although as I'm going to show you, even the greatest opponents of Milton Friedman, the greatest intellectual opponents of Milton Friedman, of whom there are some terrific ones, incredibly smart people, even they will agree that the fact is that shareholders own the corporation. Yeah?
But shareholders, as you said, there are a variety types of people
Yes.
from the society.
Yes.
So it's not incorrect to say that the societies own the films.
True, right? In a sort of indirect way, in the sense that, so I'm going to show you a statistic that 53% of U.S. households own some stock, own shares in some company. So that's millions and millions, tens of millions of people who own shares in the company. So in that sense, it is, but it's only the people who own it. It's not everybody. So it's some people, not everybody. Now, that's where the stakeholder people come in and say, well, maybe the question is, should the company be managing the interests of everybody, not only the 53% of households who own the shares? So that's where you start getting into these questions. It becomes an ethical question too. But fortunately, Milton Friedman left room for ethical questions in his statement. So, okay, so important when we think about this question, understand the structure of the corporation. Another very important concept that's going to be useful here is what's called the principal-agent relationship, or the principal-agent problem. Those of you who study economics have heard about this, but a principal-agent relationship is any relationship where you have essentially a boss and an employee, but it sort of expands that to situations that you don't typically think of as being like a normal employment relationship. It's any situation in which you have a principal who is hiring an agent. So, you know, someone who is hiring someone else to do something on their behalf. It could be to invest their money. It could be to manage their company. It could be to represent them in a court of law. So those are all principal-agent relationships. And they're challenged by the fact, all of them are, including employment relationships, that both of these individuals, the principal and the agent, have some self-interest. The agent has self-interest, right? An employee has got self-interest. An employee's self-interest, if they're really being truly selfish, they might be interested in doing things on the job that sort of build their own outside career options, but don't necessarily do exactly what the boss is interested in having them do. I've been in that situation before. I work with people. You know, that's just the human nature, and it's just smart. It's just people acting in their own self-interest. It happens. It could happen that the agent, the employee, is just not that ambitious and just doesn't really want to work that hard. Okay, well now the principal has a problem of how do I incentivize the agent to actually work hard? Maybe I have to compensate them in a way that's going to reward them for hard work. So that's what a principal-agent problem is. Anytime you have a principal who is, anytime you have one individual who is hiring another individual group to act in their own interests, right? And so you have this problem where you sometimes have to find ways of structuring that relationship. And what I want to do is I want to look at this structure of the company again and just think a little bit about where are the principal-agent relationships here. I know there's a kind of flow chart here, but does anybody see anything here that cries out to you saying this is a principal-agent relationship? The board of directors and the manager, right? So the board of directors is this group of people who, maybe the founder of the company, other shareholders have elected in order to oversee the running of the company. They're the ones who have to pick the CEO. The CEO is the key person in the manager's box there. So they have to pick the CEO and the CFO, the other top managers of the company. So tell me a little bit about the principal-agent relationship that exists. These managers are supposed to report to the board of directors. What are some of the conflicts that could emerge there? Go ahead, yeah.
The manager is actually appointed by the board of directors, but he should manage the company in the interest of the shareholders.
Mm-hmm.
But he might want to do what's in the best interest of the board of directors, so
Mm-hmm.
keep his job. And
Yes.
also he wants to make maybe his salary bigger, but it's
Yes.
also more expenses to the company, and then the profit is smaller.
Very good, right? All those things are very good, right? So one thing is there's this sort of triangle here. You've got the shareholders, the board of directors, and the managers. And the manager is really supposed to be acting as shareholders, but board of directors might want something else. That's one thing. And you pointed out that they obviously want to increase their salaries, so they might be doing things to try to do that. They're going to the board of directors saying, you need to give me a raise. You need to give me a raise. Well, that's in their own self-interest, but it might not be in the interest of the company. Yeah, go ahead. Yeah.
CEOs can technically sign contracts, but then they could do that, and the board of directors might not approve it, and sometimes so that's kind of an issue here.
Yes.
But he was given an agent position, so he can technically do that.
Right. So he can technically do that, and maybe he's going to enter into contracts or do things that the board doesn't agree with, and to build on that, the board might have a hard time even finding out about that. A company is a very, very complex thing. The CEO of a company spends basically 20 hours a day running the company. I mean, CEOs are spending about 4 hours sleeping and 20 hours a day running the company. The board of directors, look at the board, pick a huge corporation out there, any enormous corporation, look at the board of directors. Most of those people have 10 other jobs. They sit on a bunch of other boards. They might themselves be the CEO of another company. They don't have the time. They're not even able to know what all the contracts are that the CEO signs. So that is a really key principal-agent relationship here, is between the board of directors and the managers. The board of directors has to somehow try to monitor. Usually we talk about the problem of monitoring what the actions are of the agent. Principals have to monitor the agent. Okay, so that's one very big one. How about related to the shareholders and the board of directors? Are there issues there? The shareholders and the managers. What are some of the issues that might happen there? Well, the shareholders, elect the board of directors. So again, you start a company out of your apartment, and you get an outside investor, and the two of you, you sit on the board, but you bring these outside people also to sit in on the board, and then that board is then in turn doing a principal agent thing with the managers. So how are you going to ensure that this feels to me in this example, I think if you're thinking about the way I'm thinking, I'm thinking, wow, I started this company, I'm bringing all these other people into this company. How do I make sure that they're all acting in my interest? Because I started the company with my own sweat equity, my own capital, and then I bring all these other people in. How do I make sure that actually they're doing things that are consistent with what it is that I want, with the way that I, whatever my vision was for this company, whether it was to make a lot of money or address a social issue. How do I know that they're acting in my own interest? And so that's, these are some of the key principal-agent relationships in a company, right? You have the shareholders who elect the board of directors, but how do you really know the board of directors is doing their job overseeing the managers? And how does the board of directors really know that the managers, the CEOs, managers or CEOs, you can think of that, or CFOs, the top executives of the company, how do you really know that they're acting in your interest? The other one that often occurs, at the company, employees, right? This is the sort of traditional principal agent problem, is the employer and the employee. So that's the general framework of the shareholder model. Now, when people see that, one question they often ask is, does this mean that managers have to take all actions to maximize shareholder value, or else they're going to get in trouble, right? So one thing sometimes you hear CEOs, in fact, I don't know if you'll be surprised to learn this or not, or maybe you already know it, but some of the greatest opponents to the shareholder model of capitalism are the managers in here, the CEOs. So the CEOs of over 100 really large US companies got together in 2019 and made a statement that said, we are not only responsible to the shareholders, we are responsible to all of the other stakeholders. So a lot of the opponents of the shareholder model are the people who are right here in the middle, the managers, senior management of the company. So and one of the things they often say is, this is a really bad model, they say, because they say, look, I'm in a really bad position if I'm a CEO. Am I supposed to take any and all actions that are going to maximize shareholder value, that are going to increase profits? What if I have some ethical considerations? What if I don't want to take it? What if I have a different vision for the company? I'm the CEO. Aren't CEOs important people too? So they often complain about that, and in particular they say they're worried. They say, this is a bad system. If I can be sued by the shareholders for not maximizing shareholder value, then it's a terrible system. Like, what am I supposed to pollute the environment if it increases profits? Am I supposed to rip off customers if it increases profits? Do my shareholders want that? Are you guys going to sue me if I don't do those things to increase shareholder value? And it turns out that is actually a sort of false objection, because particularly in the United States, but also many other legal systems, you have something called a business judgment rule, which actually gives CEOs a lot of leeway to follow ethical principles. They do not have to do things that they view as unethical in order to maximize shareholder value. Okay, so nobody is forcing them to do things that are unethical to maximize shareholder value. And ethical can be in their own estimation. So there's something called the business judgment rule. It gives them latitude to act. And it says that courts will not review business decisions of CEOs. The shareholders can't drag the CEO in front of a court, and the manager can't drag the CEO in front of a court and say, you made a decision that wasn't consistent with my wishes. They can only do that in really extreme situations. So if the CEO did not act in good faith towards the shareholders, right? If the shareholder can prove that the CEO in text messages or emails intentionally said, I would really like to make the lives of my shareholders really miserable and horrible. I want them to lose as much money as possible, so I'm going to do this terrible action, right? If you get emails like that, then if you see emails, then you can sue the CEO of the company. or if they behaved without caution that any ordinary person might have had, right? Then the CEO is in trouble in front of a court of law. Or as long as the CEO argues that they thought that what they were doing was reasonable, they're protected by the law in the United States. Yeah.
Well, it's really undefined. What is a good faith, or what is the caution? So, in my opinion, if you took their money, they're the one who takes the shot. If you want to take the shot, don't take their money.
Yes.
So even if one person give you $1, he can make, or she can make, any decision that influences the business, because it's her money. She took the risk.
Yes.
So nobody cares about your good faith or caution, whatever.
Right.
It's her money, not
Right.
yours.
And so if you're a shareholder and the CEO is not, you recognize that they're not doing what you want, your remedy is to remove them, to fire them, and to hire another CEO. That's perfect. That's your remedy. You have less of a remedy, at least in U.S. law and in many systems that follow this, to take them to court and say, you didn't do action X. Action X would have increased my profits, the profits of this company. Therefore, I'm going to sue you and make you legally liable, so that the U.S. courts protect the managers from that. But yes, at the end of the day, right? Then I agree with you. The shareholder is the principal, and these other actors are the agents. And so that's it's the capital of the shareholders, right? Without the shareholders, the company wouldn't exist. So I agree with you. Yeah.
May I ask, like on the other hand, but the shareholders did take the risks. That the idea, if you put $1 in someone that you believe in, then you put only $1. It's like he gave an idea, he had a vision, he did a whole company, and you brought only $1. So this is a risk you take.
Mm-hmm.
So I'm not sure that I'm going to give voice for any one person that give me $1, considering the fact that our pension and other money that we don't even know about are involved in in other shares. So I don't know if you know, but a lot of us have voices that we never used on a lot of companies. So,
Correct.
And I'm
Correct.
not sure that it's a good idea that I will put my voice in a company.
Correct. Right. So and the point that you're making there is a point that we're coming up to very, very soon here, which is that a lot of you have actual voices in corporations that you could have, but it's hard for you to know on a daily basis or manage on a daily basis what exactly is going on. So you have this principal-agent relationship, and that's what makes it interesting and challenging. And I think another thing you were alluding to as you were talking, I was thinking, suppose you founded the company and then you've sold off shares in the company to a majority. The majority of shares are owned by other people. It's like if you're the founder, and so does that give you some kind of special additional right to be able to define things, or should you really be going around and asking what all of these different shareholders think? You started the company. So that would seem to give the CEO, if you're the founder and the CEO, but the company is owned by a lot of other people, that would seem to put you in a special situation relative to them, even though you might not be the majority shareholder anymore. So, yeah.
Is there a function like if I start a company and I want full control, and my idea is like popular and people want to invest in me, and I tell them you can invest in me, but it's only for profit.
Yes.
You'll get like 10% of the shares,
Mm-hmm.
then you'll be able to sell it in a profit if I'm successful, but you will not have seats in the board, you will not do anything.
There is a way to do it. It's called dual class or multiple classes of shares. You can sell shares that have no voting rights or limited voting rights. You can, this is the beauty of the capital system. You can write whatever contracts you want. And if people will buy into the company under those terms because they trust you so much, then it will work well. Turns out a lot of the really massive tech companies, Facebook, Netflix, they've got dual class shares. The founders didn't want to give up. Pardon me? Berkshire Hathaway, yeah. The founders didn't want to give up control. So it's possible as a buyer into that company, you have to ask yourself, do I trust the man? Do I trust you that much that I'm willing to not even have a vote, so that if you're not doing a good job, I can't even kick you out, even though I own the shares? So great question. Yeah, go ahead.
There's also this conflict between like long-term and small-term vision.
Good.
I mean, sometimes the board wants to maximize profit, and gets like the fruits of that as soon as possible.
Good. Yes.
As in many ways, like the CEOs usually have a midterm and long-term vision.
Yes.
But usually when there's a conflict in that, which is not necessarily illegal or like bad faith.
Right.
Like how are these disputes settled?
Okay, very good, because that is one of the key objections to the shareholder model. That's one of the key objections that get brought up. I was going to do a trip back in time on the origins of the business judgment rule, but I'm going to skip it. I'm just going to say that there's a long legal precedent of the business judgment rule. So we went back in time 300 years, and then we've returned. And what I want to do is I want to raise these criticisms here of shareholder theory, right? So one is exactly what you just said, which is that, what if shareholder-dominated companies focus on short-term stock price rather than long-term value? Short-term stock price rather than long-term value. You hear this criticism thrown around a lot, especially to shareholders that have a short horizon, like hedge funds. I was talking to someone last night at the event who runs a hedge fund. Hedge fund is an investment firm that does a lot of trading. You're buying a stock. 3 seconds later, you're selling the stock. You've got an algorithm that's trading stocks for you, buying and selling, buying and selling. What kind of owner of the company are you? You're not going to be really interested in thinking about really, really long-term value, right? That seems like not the kind of owner that's going to be able to pay much attention to what's going on. You're just interested in short-term stuff. So that's one of the big criticisms. We'll talk about that in a sec. And the other big criticism, there are many other ones, including the one I said before, which is some people say, shareholders don't really own the company. There's all kinds of criticisms. Another one is, under the current framework, shareholders are free to engage in activities which harm other stakeholders, and that's bad, right? There is something bad about the idea if it's possible for a CEO to run a company in a way that's really abusive towards their employees, right? If it's possible for that to persist in equilibrium in an economy, you kind of feel like there's something kind of bad about that. So should we be worried about those two things? And so let's talk through these things, starting with the long-term, short-term. Oh, and I'm going to introduce here the stakeholder model. So these objections form the basis of the main alternative model to Milton Friedman's shareholder model, the one that I guess 25% plus 17% of you voted for, right? So 43% of you voted for a model that was a stakeholder model, one of those last two choices, which was codified by the Business Roundtable in August 2019. This has been going on for a while, but they wrote it down. The Business Roundtable is a group of CEOs. They are a group of managers. They are agents in the company. They are not representatives of shareholders. They are the agents, but they're important people because they are people who are the big CEOs of big companies out there. And they wrote, each of our stakeholders is essential. We commit to deliver value to all of them for the future success of our companies, our communities, and our country. Companies should serve not only their shareholders, but also deliver value to their customers, invest in employees, deal fairly with suppliers, and support the communities in which they operate. So when I read this, I think two things. The first thing I think is, well, who can object to the idea that you should deliver value to customers, invest in employees, deal fairly with suppliers, and support communities? These are, nobody would sort of object to the idea that a CEO should behave that way. If I were a CEO, I would certainly want to behave that way. I would use the business judgment rule to justify my behaving that way. So that seems like sort of things I would want to do. And also, how long is my company going to be around if I deliver really bad value to my customers? If my products break after 2 months, it's not going to be around very long. We do exist in a competitive economy. How am I going to be able to? We have an incredible shortage of talent in the labor market here in Israel and the United States. How am I going to be able to run a company if I'm not investing in my employees? My employees are super unhappy and want to take off at the first available opportunity. It's not going to go over. The company's not going to be around very long if I don't act this way. So both under just for ethical reasons, which I'm allowed to use under the business judgment rule in the shareholder capitalism model, and also just for the purpose of ensuring that my company survives, I'm going to want to do these things anyway. So that was one thought that I had with this. The other thought I had with this was, how would I feel if I was a shareholder of a company and my CEO came to me with this statement? It's a little bit like you've employed somebody and they come to you and they say, I'm not actually really working for you. I'm going to work for a bunch of other things. I'm going to make sure that, or in the wine store example, I was prepared to tell the member of Congress that they wouldn't feel too good if the CEO they left in charge of the company while they're running the country here told them that they were just going to be giving away free wine to customers because it's in the customer's best interest. That wouldn't wouldn't be very much in the interest of the shareholder. So but remarkable that these are the CEOs. These are not the shareholders. These are the CEOs. So let's dig into some of these. I'm going to skip ahead to some of these objections here. So how valid are the criticisms of the shareholder model? We're going to talk about that, and then I'm going to sort of end before I go to Q&A, talking about this term called ESG, environmental, social, and governance investing, which is closely associated with this new stakeholder model of capitalism. So short-termism, this is what you brought up. Short-termism. So short-termism is the question of, what happens if the company is making decisions that incur long-term costs that are not reflected in the current stock price? Do you have a question, or do you have a question? Yeah.
I just wanted to know if you think that the short-termism has increased in the last years when you have more of day trading and using more.
Yeah. Well, I think that the fact that there is a lot of day trading, there's a lot of hedge funds, or even second trading. Day trading is you're buying at the beginning of the day, selling at the end of the day, or vice versa. The guy I was talking to last night, he runs an algorithmic trading firm. He writes computer programs that are buying and selling stocks every millisecond. So certainly the proportion of short-term shareholders in the market has increased. That's true. But what's the impact been? And that's what I want to talk about here. So if short-termism is a problem, then the company could make decisions that focus only on the short term instead of the long term. But if you look across countries, the evidence of how companies actually behave and also how markets price companies is not consistent with short-termism being a really major problem for the management of a corporation. So these two graphs show a couple things. This first one shows the R&D, level of research and development, as a share of assets in the United States, Australia, Canada, some other countries here. And we see that, it's very high. China's missing because there was no data, not because it's zero. It's not zero. But it's low in some places because it's also hard to measure. But particularly the US, Australia, Canada have got really high values of this. Even more compelling to me is, percentage of IPO. What's an IPO? Yeah, when a company goes public, right? So for the first time when you go get outside investors in a big market. So remember, you founded that company in your apartment. You're working on it by yourself. The next step when you need some capital is you'll get a venture capitalist to invest in your company. The next thing, years down the line, is you sell the shares to the public on a stock exchange. You're getting a really broad group of shareholders. So look at the percentage of IPOs with an earnings loss during the past 12 months. So what that means is, let's look at the United States. 65% of U.S. companies, under this data in this Bagat et al. Paper here, they had a earnings loss during the past 12 months, meaning that shareholders were willing to buy shares in a company that was losing money. And in some cases, they're doing this losing money hand over fist. So here's some examples of some companies you might have heard of, or use. So Dropbox, I use Dropbox a lot. All of my stuff is stored in Dropbox. So in the year before the IPO, Dropbox was losing 31 cents per share. Shareholders, market participants, were willing to say, I'd like to buy a share of that company for 21 bucks a share, even though the company is losing 30 cents per share each year. Interesting that the market's willing to pay that for a money-losing company. Here's another one, what is this symbol? Anybody? I think it's Robinhood, We're losing $2.59 per share. The market says, I'd like to buy shares in that company that's losing $2.59. I'm going to pay $38 for each share of the company that's losing $2.59 per year. Interesting. Here's Spotify, another service that I use a lot. 12 months before the IPO, they're losing $5.30 per year. And investors who've got cash say, I'm excited about buying that company. I'd like to pay $132 per share for this company that's losing $5.29 per share. Here's one, Airbnb. It's losing $12.59 per share. And investors with money say, I want to own a share of that money-losing company. I want to pay $146 per share for a company that's losing 13 bucks a year. So this isn't to say that short-termism is never a problem. It's also clear that there are a lot of shareholders out there that are short-term. But it also seems to be the case that there isn't really a problem in markets of raising money for companies that whose value is in the long-term, distant future. Right? That's why people are jumping up and down to buy these companies, because they think that in the long run, these companies could be worth a lot. Great example of this is the financing of Amazon. So I'm old enough to remember, the sort of Web 1.0 tech boom and bust of the late 1990s and the bust in the early 2000s. And Amazon, a share of Amazon was trading at $106 per share in 1999. By mid-2000, it was trading at $6 per share. Okay, this stock was viewed as being mostly trashed at that time. Okay, that investors had lost 95% of their value that they had invested in this company. The company lost money for another decade and a half after that. But now they're making tons of money. So how short-term are markets really if the capitalist system in the United States was able to finance the growth of a company like that? It just can't be that short-term in nature. So that's what I would say about short-termism. Now, another point to make is, and we skipped over this a little bit, but I want to go back and say a little bit. I mentioned this, that who owns shares? I say that around 53% of U.S. households own some sort of traded stock, and another 10% who have no direct holdings own stocks indirectly via pension funds. And that is that pension funds and also most of the households is long-term capital, right? Some of the households are day traders, sure, but most of the households are owning stocks through their retirement accounts or their long-term savings. So those are kind of who the shareholders are. Okay, and this gentleman here, this is a guy named Leo Strine. He was the long-term Chief Justice on the Delaware Supreme Court. Now, Delaware, you might know, as being a small state in the United States where the President Joe Biden comes from. But the really important thing about Delaware in the United States is that, you're going to be surprised to learn this, maybe, that well over half of U.S. companies are incorporated with their legal documents in the state of Delaware. And that is because the state of Delaware, a long time ago, tried to create an environment that would be very, very legally sound for companies. It's not that the companies are all located in this tiny state of Delaware. They're just sending their documents over there to be incorporated there. But what it means is that every lawsuit, every legal dispute about companies that are incorporated in Delaware goes through the Supreme Court of this small state, Delaware. So now you know two reasons Delaware is important. One is that Joe Biden is from there, and the other is that it's the law that governs most corporate activity in America. It's pretty crazy that we have a country that works that way, but that's the way it is. So this gentleman is often pointed to as being one of the key proponents of the stakeholder model. He's always going out there saying companies should really find ways of acting in the interests of broader stakeholders, not only shareholders, but also customers, employees, suppliers, and so on. In fact, there's a very long quote up here. Some of these legal people, they can just talk on and write on. It's just unbelievable. I'm a business school professor, and I just sometimes want to tell these people, just get to the point. He wrote this whole long statement here, using the relative luxury of an academic, journalistic, oh my gosh, I'm tired just reading the beginning of this statement. But the last sentence is what's really important. He wrote, "The only way to make the world be more like it ought to be is to be willing to be clear-eyed about what it is." And if you read this article and you read this statement, for him, ought to be is his stakeholder view of the world. He wants the world to be more of a stakeholder world. And I put this up there because I want to show you that even the most expert and well-respected proponent of the stakeholder model is saying that, in fact, legally, that's not how the world works right now. So legally, he's saying, this is my translation of what he says, I wish it weren't so, but under current U.S. law, corporate boards, and hence the managers they appoint, owe their duty to shareholders. So that's the way the law works. So what's the new approach, right? So the new approach that a lot of people want to put in to codify, to solidify this stakeholder model is something called ESG. ESG stands for Environmental, Social, and Governance Investing, and it's investment that's focused on these kind of three areas, right? Environment, which is improving the natural world, especially by fighting climate change, preventing pollution, and so on. The second is fostering relationships in the community by focusing on diversity, equity, inclusion. Other things. The third is enhancing corporate governance. That's the G, by emphasizing board composition, cybersecurity, corruption. So the third one is something that's been around actually for a long time, governance. There's nothing new about good governance. I mean, good governance is actually, in a way, just the principal agent problem between, shareholders, boards, and managers. Good governance is going to be practices that solve that kind of problem. The other two are new, right? The other two are more stakeholder views, right? If you want to improve the natural world, now this is now in the realm of the fifth choice of the choices that you could vote for, where you say companies should be, thinking about the environment, or in the second one they should be considering racial justice. So that gives a broader kind of mandate to the company, and this ESG has become incredibly important. Worldwide, there is $24 trillion invested in assets that purport to be ESG. It's gone way up, right? Here's a graph of assets under management in ES or G types of strategies. And early on in the 1990s, we had a lot of this lighter red, which is the shareholder advocacy. That's just good governance. That's just saying, we're going to focus on how we fix these principal agent problems. But lately, right, this entire sea here of, tidal wave, really. Well, I guess right now it's a wave goes down. I don't know if this trend is going down anytime soon, but this is certainly a uptrend in the tidal wave. ESG is where it's all at, right? By some estimates, a third of total financial assets under management have an ESG label to it. So this stakeholder model has really come up from essentially nothing to like a third of all assets that are under management. So it seems like it's a very important thing. Now, there are many ways you might be thinking, okay, how do I measure how good a company's ESG is? Well, that's a great question. So let's look at that. And I guess to start out by thinking about that, what I want to do is let's think about some issues where you think that things might be, I don't know, hopefully they might be straightforward. I mean, one issue is, okay, let's think about global warming and carbon dioxide emissions. So seems like if you're a proponent of the stakeholder model, you're thinking, okay, I really want to try to favor companies that don't pollute the environment, or I want to favor companies that don't generate a lot of CO2 emissions. But it's difficult because it's not as clear, and as you might imagine. You might say, well, a company that is investing in fossil fuels, for example, is doing bad things as far as my ESG tastes are concerned, and therefore I don't want them doing that. The challenge is that public opinion, and also the opinion of the shareholders, isn't exactly what you might imagine it to be. So this is the United States of America, and you can look at polls from other countries, and some of them are going to be, different in various directions. But this is a poll from 2021. So it was published in early 2022. The data were collected in 2021. So it was actually before the big spike in gas prices and before the war in Ukraine. And Americans were asked, and this is a little bit small, but I'll read it out to you. Do you favor dramatically reducing fossil fuel use to curtail greenhouse gas emissions over the next few decades? So do you want us to use less fossil fuels in the US? And 60% of Americans said, yes, I'd like less fossil fuels to be used in our energy mix. This is the Gallup poll. This is the most nonpartisan and just objective polling organization you're ever going to find. So the next thing they asked was, okay, well, we're just going to ask now, do you favor reducing oil as a source of domestic energy? Well, now only 39% of people said they favored reducing oil. So I guess maybe the remaining 40, the sort of difference here, the 21%, I guess maybe they want less coal, perhaps? Next, they were asked, do you favor reducing natural gas as a source of domestic energy? Only 19% of Americans favor less natural gas as a source of domestic energy. Only 19%. And yet ESG says anybody who's producing natural gas is basically violating ESG principles. So that seems to be a bit of a problem. The real question is what the shareholders of the companies want. But let's face it, the fact is, I mean, it's kind of a brutal fact, but only 19% of Americans actually favor less natural gas in our energy mix. And yet, the whole ESG movement says, for everybody, 53% of Americans own stock. Only 19% of Americans want less natural gas as a source of domestic energy. And increasingly, investment firms in the US are saying, we're implementing ESG in everything we do. It seems like there's a bit of a disconnect here. So it's tricky. Another issue, I'll poll you on another issue, okay? So you can get out your polling here. This one is one where there is actually an answer as opposed to an opinion. So scientists estimate that over the period 1905 to 1925, about 100 years ago, approximately 4.1 to 4.2% of global land burned by wildfire. Okay, we heard from John Medvedev last night. He's interested in investing in companies that are going to replenish forest areas that were destroyed by wildfires. Question for you. Approximately what percent of global land burned by wildfire in 2021? So 1%, that would be a pretty significant decrease. 2.5%, that would be a slight decrease. 5%, that'd be a slight increase. 7.5%, that'd be a big increase. Or 10% or more, that'd be a huge increase. Not going to give you too much time because you could Google. And as I said, I know your Googling skills are excellent. So just put something in. Let's see what you think. Okay, I mean, I've read the headlines. There are articles about this all over the place. So I know what I've read. All right, let's see what people have said here. Okay, let's lock it up. Let's look at the responses. So pretty evenly distributed among the answers, right? So I would say it looks like about 27% of you, if I'm adding 8 and 19 correctly, believe it's gone down. The rest of you believe it's gone up. It turns out that actually it's gone down very substantially. So, and these numbers, they're published in the Wall Street Journal, but you can go, I've gone and read the actual source for these in an article written by Bjorn Lomborg, but you can go look at the source, and this stuff is completely unquestionable that there is less of the world that is burning by wildfires than there was 100 years ago. Now, some of this is because people have gotten better at managing forest area, managing woodland area. But it is not actually consistent with the data to say that more of the world is burning and is on fire. So what are we doing? We're thinking about investment in ESG. Well, it's nice if investors care about replenishing forests. That's great. Let's have companies that investors. If you want to invest in that, I want to invest in that. I think it's a nice idea. I'd probably invest in it. Great. But what might not be a good idea, or what's not consistent with facts, is to say we all need to implement principles that are going to allow any money manager out there to say, I'm going to exclude these types of firms, or I'm only going to invest in companies that behave in a certain way on the grounds that the world is on fire. It's just not supported. There's just some things that are not supported by the data. Yeah, here and then here. So go ahead.
I wanted to ask, who's the creator of these ESG? Because
yes,
I'm understanding that it's some kind of people that I assume have some interest that put these parameters. And now basically the CEO has to go by these specific parameters
yes.
To look better, for his company to look better on ESG, but basically it doesn't give him actually more judgment. It just gives him more work to do to comply with the ESG, but not necessarily, like you're saying, it's what the public wants. It's not necessarily what's good for the company. So I'm kind of asking,
yes.
What difference does it make, or is it mainly marketing and trying to, take ESG and make it like the new society, since it's critical in social media and all that?
Right. Right. Great question, right? So it seems to be not exactly what the majority of the population really wants. It seems also to not really be what a lot of shareholders necessarily want, and yet it seems to be something that everyone is really, really focused on. You said, is it marketing, right? I do think a lot of it might be aimed towards marketing towards certain types of investors or investor capital. So one type of investment capital that's very, very focused on this ESG are state investment funds, like pension funds. So in the United States, we have every state of the United States has a pension fund for its public employees. That money adds up to $4.5 trillion. California's got a huge one called CalPERS. Every state has its own. That's very ESG-focused money. Then there's definitely a portion of the private market for just private investors who are really focused on this issue. You poll people, some people really want to invest in this. My view is that I think some of the people who think they really want to invest in this don't really know what it means. And I also think that they are probably placing too much confidence in this as something that's going to change the world. So one ESG strategy is to say we're not going to invest in companies that that do oil and gas exploration. Well, what's happened is that a bunch of funds have divested themselves from oil and gas, but there's a new investment fund out there by a guy named Vivek Ramaswamy, and it is the Anti-Esg Fund, and he invests only in the oil and gas companies. And he's got there's a lot of money flowing towards his companies. So what we've sort of seen is just a reallocation of capital. Some people have kind of woken up and said, I don't want to invest in this stuff. And some investors have come along and said, oh, I'm going to give you some funds that don't have any of this at all. And then this other person over here has said, well, anybody who wants to invest in this, come over here. We'll do it. The symbol for his ETF is DRILL, D-R-L-L. So he's really going all out there. He's not hiding what he's about. So I think it could be, I think it's marketing to certain types of capital, but it's also become now an issue where the government is now getting involved in saying, should we require firms to follow ESG principles? And that's a lot what this hearing was about, and that's where I think things start getting a bit dicey, because great if investors want to sort themselves into, and Milton Friedman I'm sure would agree, if some investors only want to invest in clean tech, they can do that. That's the free market. They can do that. But the government probably shouldn't really be getting involved in saying we want to try to steer more and more investment towards ESG. So I'm going to take you and then you. Yeah. So go ahead first.
I don't know how much this graph is reliable, because the amount of trees since then is half.
Okay.
So I don't think...
The amount of trees is half in the world?
Yeah, we heard this during this week. Since the last 100 centuries,
yes.
The last 100 years, that was a decrease in the number of trees. So I don't know how much we can take this as a
right.
optimistic.
Well, no, that's a great point. Yeah, that's a great point. I mean, I think what you can't say is that it's not really true to say the world is on fire. Yeah. And a lot of that is what's driving this whole thing. So we have to get the facts straight.
Much more headlines all over the
yes.
media.
Yeah. That's exactly the main point. Is that like media's got its headlines. Data is something else, but yeah, I mean that and if it doesn't mean that we don't need, as I said, it doesn't mean we don't need to replant trees. I'd invest in this company. I liked the idea. So yeah.
I think it's more than just the government's a little bit steering it this way.
Yes.
They're heavily steering it this way.
Heavily steering it this way. Yes.
Paris Agreement is just like declaring that we're not going to use oil like in whatever year,
right.
So those companies are going to go bankrupt,
right.
So you better not invest in them,
right.
And
right.
all central banks are already involved in this, and
yes.
It's huge. So
it's huge.
And when the European Union, they issue bonds towards that, they're not really allowing the free market to happen. They're heavily telling the people, you
right.
need to invest in this because this is profitable,
right.
And they subsidize it with taxpayer money.
They're also subsidizing it,
so
yes.
It doesn't matter what the majority of the people think. If the majority of the government or the rich government think this way, they're just going to pour that money into that area. So there's not really free choice. Of course, the investors want to invest because they see the government's getting involved, so
right.
it's secure.
Right. So it's
what's the
yes.
counter action? There's no counter action.
Well, you're right. It's more than just the light steering. So, the central banks are getting involved. Governments are subsidizing the one technology. They're saying we're not going to invest in the other one. It then makes investors want to invest in the one that's being subsidized. So, so what's the counteraction is to try to, this has to happen through, some kind of political change or through trying to, say, for the people to say this isn't what we want, for a democracy. So it's a huge challenge. I agree with you. I think things have gotten kind of out of control with this. I want to go to generally Q&A, but there's a couple other things I want to show. One is just briefly, these ESG metrics are also they're highly subjective. So here's a few companies, and there's these three firms that do ratings of ESG. They say they're the ones who are kind of charged with saying how good is the ESG behavior of these firms. And one thing you see is that there's just a lot of variation across the rating firms. So Coca-Cola, for example, this firm gives Coca-Cola 79 out of 100. I guess that's pretty good. I mean, when I was in school, that was a C+, but I hear there's been a lot of grade inflation and stuff, so I guess that's pretty good. Sustainalytics says it's a high-risk company, and S&P Global gives it a 34 out of 100. I mean, that's definitely a low rating. Here's a company, Philip Morris International. They make tobacco products. Yet somehow they've got a super high ESG rating. I don't really understand that. I mean, what are we measuring here? Is it really, I mean, it seems like from a global health perspective, it makes little sense. I guess Coca-Cola is also bad for you. Cigarettes are also bad for you. It's unclear what they're measuring. British Petroleum, right? They're an oil company. Refinitiv gives them a really good rating. They're getting it. That was an A- even in my day, right? Today that's probably an A+. I don't know. 90 out of 100. That's pretty great. But Sustainalytics says it's high risk, and S&P Global says 49 out of 100. I suspect this is because BP, had a lot of meetings with the rating agency at Refinitiv and said, oh, but we've pledged we're not going to do more exploration, and we're going to go carbon neutral, and we're doing all this stuff. And Sustainalytics wasn't buying it quite as much. So the point is that these ratings are hugely divergent. And the idea of a rating agency came from companies that rate the credit of firms. Companies that rate the credit of firms like S&P, Moody's, Fitch, they're totally in agreement on stuff. That's like, they all give the firms basically the same grade. The fact that the ratings are so different across these firms, this company makes sneakers. I mean, I don't know exactly what they're doing, but could they be as bad for ESG as BP? I don't know. I mean, maybe it has to do with their labor practices, unsure. Tesla, I mean, I don't get it. I mean, they're making electric cars. The state of California just said there will be no more gasoline vehicles sold in California starting in 2035. There will be no more gasoline vehicles sold in California in 2035. How can Tesla not be then an important company or a good company from the perspective of ESG? It just makes me scratch my head. There's a lot of, and of course I've dug into this. I didn't just scratch my head and say, huh. But there's a lot of arbitrary stuff that goes into these ratings. A lot of different types of things that they're looking at, including workforce, looking at a lot of different types of things, and so it becomes very, very, very subjective. By the way, 3 days after they announced they're not selling gasoline-powered vehicles in California starting in 2035, the governor of California told us all, it's too hot, the power grid isn't strong enough, don't charge your electric vehicles this weekend. So I don't know, somehow the grid is going to have to grow an awful lot for this to work out. Okay, I think there's just one other thing I wanted to say, and then I'm going to totally open it up. One of the other real issues here has to do with the principal agent problem between, say, all of us and the big firms that might manage our money. So in the United States, if I have a saving fund for retirement, it's managed by one of these big companies, right? So it's managed through Vanguard, BlackRock, State Street. Another one is Fidelity. So and I put my money in mutual funds or ETFs that are run by these companies. And these 53% of households who own stock, plus 10% who own in pension funds, a lot of them are investing through these companies. And nearly half of all equity fund assets are passive funds, representing $11 trillion in value. So what they say is we just try to buy the entire stock market index. That's like what the Vanguard S&P 500 does, or BlackRock, State Street, and so on. And so one of the real challenges that's coming up here relates to these companies and the fact that Vanguard, BlackRock, State Street, every time some issue comes up for a corporate vote, they are big, big players at the table because they are the ones who are managing all the shares on behalf of me and everyone I know, right? And so the fund managers at these companies, they are the ones that are voting. And recently they've been voting a lot on ESG and promoting ESG principles. And I don't really have an avenue if I don't agree with these principles, or I have a different view of ESG, or maybe my views of ESG are more like that of S&P Global than that of Refinitiv, or maybe I prefer one set of ratings to another. I have one set of views or beliefs. I have no way of expressing my opinion to them about how it is that they should vote, because there are too many of us. This is the point that you were making. There are just too many of us. And so the last quote that I'll leave you with is this gentleman here. He is the manager of one of the enormous index funds that manage all this money on behalf of people, and at the company called BlackRock. And he's been very vocal actually the picture is of somebody who's criticizing him named Charlie Munger, but he's talking about a guy named Larry Fink. Larry Fink is the CEO of BlackRock, and he is talking about how he tries to vote as much as possible for ESG everywhere. But the shares that he's managing are shares that are owned by millions and millions of Americans, not all of whom agree with his vision of ESG principles or even ESG principles in general. And so this gentleman here is Charlie Munger, who's the vice chair of Berkshire Hathaway, and he said, I think the world of Larry Fink, he wrote this in the Wall Street Journal, but I'm not sure I want him to be my emperor. I'm not sure I want him to be my emperor because this guy Larry Fink is so powerful because he gets to choose when a corporate issue comes up. You know, should BP do less drilling? Should Coca-Cola move its operations outside of Georgia because of the contested election issue in Georgia? How do we view all of these companies that are doing things? How do we balance off these different considerations? He's the one, because he's the one who runs this enormous fund who's making the calls. And so there's a tremendous amount of power vested in these, basically three individuals who run the huge mutual funds at these three companies. And so they are also going to this question of, who's actually calling the shots, who's pushing this. They are also ones who are contributing to push it along. And I think we need to think about, is there a regulatory framework that we can put in place that would ensure that these funds are at least voting in the interest of their shareholders, because the shareholders, just going back to my first point, are the ones who actually own the shares, and they're the ones who actually own the company. It's a principal agent problem to make sure that their views, or in the case if you own stock in companies, that your views are represented in corporate decisions. So that's it. I went on a little bit longer, but we had some interaction in the middle, so hopefully some people got to.
Thanks for a terrific lecture. Question about ESG. Can you enlighten us about the latest and best measurement mechanisms of ESG? I think I read in Harvard Business Review last year that some $30 trillion of managed assets are subject to ESG criteria. Well, how do we measure it? How do we measure the impact on the environment? How do we measure how much Coca-Cola is improving or destroying the environment?
So each one of these companies here will tell you that they have some amazing proprietary technology for doing this. And the fact that there's so much difference among them tells you that they're each using very, very different principles. And I mean, another hard thing is, how do you balance E and S? I suspect that's what a lot of this disagreement is about, right? So I'm suspecting that Skechers does not have nearly the same environmental impact that BP does, but perhaps on a societal impact, I'm guessing that they have issues with their labor force. So there is no standardized measure. And that's why it's kind of dangerous. Now, policymakers are going in two directions. Some policymakers are saying, we, the government, need to standardize the measurement. There are some people who are saying that. So the Securities and Exchange Commission, for example, the United States Securities Regulator, is saying, we need to get standardized measurements in here, so there's going to be one measurement. There's a problem with that, which is, why are they going to decide what I'm the shareholder, it's my capital. You're the shareholder, it's your capital. Why should the government decide what your principles should be? Why should the government decide which of these things you care about? So I think it's become something where there needs to be, the second direction for regulatory policy, and the one that I push, is that we need to create mechanisms so that individual shareholders can express more opinions to the fund managers, to Larry Fink, to BlackRock, to Fidelity, to Vanguard, to whoever I'm investing my money with, to say, these are my principles. So if I had to say what policy I would like to see put in place, people ask me, what should regulators do? What I say is, well, regulators should say that, when a company manages shares on behalf of somebody, they have to give that person a survey and ask them, not for every single of 3,000 companies how they would vote on every single issue, but they need to actually poll them on what they want on certain blocks of issues, and they need to act accordingly. And this whole ESG ratings system can just be thrown out because it's all totally subjective. Maybe, sure, you can have some firms that maybe are going to specialize in telling you how much carbon emissions does this company produce. That's great. That's a data point. Sure, okay. Or individual ESG criteria can be listed. But this, okay, we're going to give some people an A+ and some people an F for seemingly arbitrary reasons or arbitrary distinctions about which of these criteria we most care about seems to me to be like a very bad direction we've gone in. And I don't think we should trust the government to standardize what is best for society. That just sounds really bad to me. It sounds very, very administrative, state heavy. We should trust shareholders and owners to say what it is that they actually want. Again, I mean, the flip side of only 19% of Americans want less natural gas is that 60% of Americans do want less use of fossil fuels in our energy mix, particularly coal. So that's probably going to be the majority view of American shareholders, and we'd like that to be taken into account by the fund managers. But if the fund manager is going around divesting from companies that produce natural gas, and only 19% of Americans think you should have less natural gas, then this whole system looks, especially if the government's saying we're going to take it over, it looks like a way of circumventing what the actual will is of the owners. That was a long answer. Sorry, I tend to go off and start getting started in these things.
Regarding the like what you said right now, when it comes to controlling the environmental crisis that we're in, sometimes people don't really know, and sometimes people won't act, and some people just go their daily lives out of habit. And it's when it comes to improving the situation, governmental, it's sort of a lot of experts think that there needs to be like a governmental
board, regulator, board, yeah.
Yeah. So, and when it comes to ESG and like the will of the stakeholders and the shareholders, it's like sort of a different topic. But when it comes to actually making like getting us out of this environmental crisis, it seems to me that there should be like governmental intervention when it comes to, let's say, regulation. Mm-hmm. Let's say 90% of people in America think that don't think that. No, like 80% of people in America don't think that they should use less like natural gas. Okay. But maybe they're not aware of the facts. Maybe there should be like something that is beyond somebody's like economical short-term motive.
Yes. Well, let me speak to that. I mean, I think one approach that you would think would be important would be to go back to the legal part of this, which is that companies are all supposed to follow the law. None of you said that the company should even. I mean, the choice number one in that poll was about whether companies should just follow the law and not even consider ethics. So none of you said that even. But if we really want to address this problem, if the society really wants to address it, why is it not being done through government, specifically through policy and regulation around carbon? So the economist solution is let's put a carbon tax on there. Let's tax something that we don't want as much of. And what seems to be happening is that instead of actually creating legislation or creating regulation, the government's saying, well, we're just going to do this all through sort of morally trying to say that investors should only invest in companies that do ESG. It seems like it would be their job to actually get it right. And if it's for democracy, if it's not the will of the people, then jamming it through is not consistent with those democratic principles. And sure, education of what's actually going on, yes. I think the 81% of people who are in favor of maintaining the natural gas level are perfectly well educated about natural gas, because the fact is that natural gas, while obviously not zero carbon, is the least polluting of all of the fossil fuels and so on. So I think that those people are well enough informed that their opinion is going to matter. But I guess fundamentally I also think like the government's complaining and saying, oh, you bad people, some of you are investing in fossil fuels, we don't want that. Well, then why aren't you putting a carbon tax on it? Well, the fact is they're not doing it because it may not be the will of the people to do that. So that's the issue. So I think regulation can happen. Putting regulation in by saying we're going to regulate by defining ESG in one way or another it's a pretty heavy-handed technocratic way of doing it. relative to just something transparent, which is we're going to pass some environmental policy that is consistent with, with science and with the will of people. Seems like it's something that could be done. Yeah.
I'm not really following the argument, because you say that the shareholders own the companies.
Yeah.
And the shareholders are approaching 60% of the population. And a growing number of like persons from the population they want to invest their money, their capital, in a company or companies that they think will do a better job protecting the environment as they see the best way. And it's like, so the regulation is not telling you who or what to love, but rather maybe standardization of what is the matrix to, like this chart is obviously not good, because you don't really know what you're checking. Are you checking how much carbon do they put in the air, or maybe the general pollution, because there are two separate things, or maybe how ethical the company is. Okay, so maybe if you can make a standardization of this thing, it's even like allowing the shareholders to express their true will and increase their agency.
So, fair point. The question is, do you want the government basically giving each company a grade and having a whole bunch of investors, telling a whole bunch of investors, it's okay, just follow what we do? Seems like you then have the government really deciding to a very, very heavy extent how people should invest their money, because there's a lot of details behind that. So, a regulation, companies having, if companies have to disclose how much, what's the direct carbon dioxide impact of their direct activities, well, that'd be a pretty light regulation right there, I would say. It's just a disclosure regulation. People can do with it what they want. Still could be hard to interpret. How far downstream do you go? Even simple things become complicated when you try to put them in. Something like that, I think, would be preferable to saying, we're going to put together this weighted average of these scores. We're going to tell you what you should care about. We're going to standardize it. We, the government, are going to tell you what's best for you. I feel that is going to be telling people, maybe even making people believe that their investment is going to have an impact where, in fact, it might not. Another thing I'll also point out, just once again, is let's say even that your measure is perfect, like, and that there is one perfect measure, and the government's able to put it together, and it's all great. Well, there's still going to be a lot of capital that's going to say, I don't want that. And then, they're going to invest in the other stuff. And that's fine. That's the way a capitalist economy works. But the people who are investing their money in these ESG strategies, they are being led to believe that that's making a difference in the world, that it's reducing carbon emissions. I actually don't think it's reducing carbon emissions at all. I don't think ESG is having a single impact on carbon emissions, because I think what's happening is that money is simply moving to other, the money that wants it is moving to it, the money that doesn't want it is moving elsewhere. And also, what's the impact through which, there have been some studies out there that try to measure the impact of like a, let's say that, ESG has tanked the share price of, carbon emitting companies by 10%. Let's say it even managed to do that. I don't think it did, but say it even managed to do that. Then how does that actually affect anything? It only affects something if that company is going back to the capital markets to raise more capital. So it has a very indirect effect. And I think another problem with it, from the perspective even of people who want to actually change the world in the ESG direction, is that they're being led to believe that ESG is doing that for them, and it's actually not doing it for them. The only way you can actually do it is with activist policies of going into companies and saying, we're going to get a majority stake in the company, and we're going to make the company do something different. So, but yeah, good point. Yep.
Thank you.
It seems pretty obvious that there is a disagreement regarding climate change or any other policies, but especially when we talked yesterday, we learned with you about the distortion the taxes can make about on people choices. But regarding the fact that the government is already taxing us, can we condition that we will put a tax on carbon dioxide, but this is something we can price to change behavior, but on the other hand, decrease the taxes in general, so to make this trade-off, so we can condition that, and then there is a space for agreement.
Yes. Well, that is actually what I would be in favor of having happen. There was a petition that was sent around, a letter that was sent around to like anybody who had worked at the Council of Economic Advisors in the last 20 years or so, including all the chairs, and it was a proposal for a carbon tax. And many of the people who had worked at CEA on both the Democrat and Republican side signed it. I did not sign it, and the reason is that it said there was going to be a carbon tax, and it said that the proceeds from this carbon tax are going to be paid out to people as a dividend, an equal measure, that like everyone was going to get a dividend. And I actually don't think that's the way that it should work. I think that it should be used to reduce other types of distortionary taxation. As opposed to sort of giving people a kind of like universal basic income. It was like a combination of a universal basic income proposal with a carbon tax without any cutting of any other taxes or changing of distortionary taxation. So for that reason, I didn't support the proposal, but a lot of people I know supported the proposal, and at least it did give money back to people. So I can appreciate the fact that was done. But I do believe that, look, if as a society we believe there should be less of putting carbon dioxide in the atmosphere, then economists have a solution for it. Let's put a Pigouvian tax on it. Let's tax it, and then there's going to be less of it. At least that's transparent. So,
Thank you very much.